So what do people want with a whole life insurance policy? Specifically when cash value is the goal. Well, what most people want is a policy that is set up for maximum cash value. What people don't want is to get a whole life insurance policy, be led to believe that the policy they took out or the policy that they started is set up for maximum cash value, only to find out after the fact that it's not. Think of it this way. You buy a car, let's say it's a beautiful sports car, maybe it's a Jag, it's a Ferrari, something nice. Let's say you spend $100,000 on it and you're told you just got a fantastic deal on this. A month later, you see me rolling down the street in the exact same car and you say, hey, cool car, I got the exact same one. How much you spend on that? I got a fantastic deal with $100,000, you say. I say, I spent $65,000. Is it new? You ask? Yeah, brand new. Same year, same model, same specs as your car. Everything's the same, but I only spent $65,000, whereas you spent $100,000. Well, come to find out, the dealer I went to was very transparent about the cost and everything and showed me exactly what the price was for that car. How do you feel afterwards? A lot of times that's where people get that sick feeling in their stomach. No one wants that. So what can prevent that with a whole life insurance policy? Because in my opinion, this is the number one issue that pops up with whole life insurance, where someone expresses, I want this policy for high cash value. They think they got a high cash value policy, and then they find out after the fact it could have been set up much, much better. The exact same company and product. We're going to look at an illustration toward the end of this video. So awareness is key. This will go a long way for you. How do you prevent a situation where you feel like this? I wasn't aware of that. I didn't know you could do that. Why wasn't I shown this before? Why doesn't everyone do it this way? What I mean when I say this, why doesn't everyone do this? Meaning set up a policy for high cash value. The reason why is that it really comes down to the agent or agency you are working with. The agent you are working with, one, needs to know how to set up policies for maximum cash value. How is the key word. And then two, they need to be willing to do so. Willing is the key word. Where that comes from, needs to be willing to do so, is because if a policy is set up for high cash value, let's say maximum cash value, especially up front, what that will result in is a minimum commission to the agent. So one needs to be willing to do that once they understand how the product works and the different ways that it can be designed. But that's often the reason why there. So with a life insurance policy, what most people want, now when I say what most people want, I'm specifically referring to people we work with, both individuals and companies. They want to A, maximize the cash value. B, have flexibility. What this means is I want the ability to add a lot of money into my life insurance policy, but I do not want to be committed to the full amount, meaning I don't want to be on the hook to pay this huge bill every single year. So can I make it flexible and use it like a flexible savings asset, paying more, paying less as the years pass? The answer is yes, if you do it right. And then three, I want to be able to access the cash value for opportunities. There are other benefits and other reasons why people often want whole life insurance that work with us, but these are the three most common reasons. Let's say this is you. What you would like to fund is $100,000 per year. This is what you would like to fund. You do not want to get a bill for $100,000 per year. I'll emphasize that piece. And quick side note. If you look at this number and say, hey, that's very, very high. Like I don't even make $100,000 per year. That is perfectly fine. What we could do as you look at these numbers is literally chop a zero off. It can be $10,000 per year. You could add a zero if you're considering a larger policy. If the policy is set up equally, the numbers are all relative, meaning it's all ratios. If we set up the policy correctly, we should have strong cash value like what you're going to see in this example. So most important piece here, one of the most important pieces, setting it up correctly. So what we're going to look at is one policy, but three different options or three different ways that this policy can be set up. This will provide awareness so you know what to look for when you're looking at different whole life insurance policies. And what we're going to aim to accomplish here, are these three goals. Number 1, maximize cash value. 2, build in flexibility. And 3, have access to the cash value for opportunities. Number 3 is right in line with number 1, because if the cash value is maximized, well, what does that do? It gives you access to more money. Whatever you have in cash value is what you have access to. So option A, let's look at the most common type of whole life insurance policy setup, which we'll refer to as a traditional setup or traditional design. Let's call it that. So we're going to look at $100K per year going in. And here we go. $100,000 annually. In this particular case, he's paying into it until he's 65 years old, starting out at age 40. Here's all I want to hit on in this example. Here's his annual outlay. So $100,000 per year. Here's his death benefit on the far right. 6.3, almost $6.4 million initially. But here's his money column, net cash value. So again, going back to the purpose of this policy, why this particular individual is interested in it, was what? Was it the death benefit? No, he said, high cash value is what I'm interested in. Does this have high cash value? No, he pays in $100,000 and he has 0 in the first year. His break-even point is year 14. What that means is by year 14, he's paid in a total of $1.4 million. $100,000 times 14 years equals $1.4 million out of pocket. And then he finally gets his money back. I like to refer to this as a fantastic example of exactly what not to do if you're interested in a high cash value policy, meaning if you're interested in cash value, that's why you're taking out a life insurance policy, or that's what generated that interest. So not attractive here. Does this maximize cash value? No, that was question number 1, or goal number 1. What was goal number 2? Flexibility. In this particular example, of this $100,000, he's just paying a premium. So it's a 100% premium example, meaning if he said, hey, I want to buy a life insurance policy for $6.3 million and change that dollar figure, it would cost him $100,000 per year. Not attractive at all in terms of flexibility because he's billed for this every single year. So we don't want this. And then goal number 3, I want to be able to access the cash value for opportunities. Well, he doesn't have access to much cash value. Year 2, he's paid in a total of $200,000, 100K for 2 years. He's got a little under $12,000 that he has access to. Yeah, not attractive. He starts to build up some value over time. But like this, as a business owner, like I would not do this. Over 10 years, I paid $1 million and I've got $800,000 in change. Like there's so much more I can do with that cash flow in the meantime to really get my money working for me. All right, so option 1, not attractive at all. Option 1, traditional. Let's just do this. X. Next, option B. We'll call it 50-50. This is a decent example, but not one that I would recommend. So let's progress on to this. Here we go. So look at this annual outlay column. Here's option A that we just looked at with the ugly cash value in the first year. Your outlay is $100,000 per year. Option B, your outlay is $100,000 per year. Much different in the first year, isn't it? Instead of a 0, we've got $51,000 in change, almost $52,000. So this is a policy where we've got the same out of pocket, but when we look at a breakdown as to where this money is going, like that's the big question, where is this $100,000 going? Because it's not just going toward the premium. In fact, let's look at that. Voila. Here we go. Here's your premium. This is the piece you're billed for each year. And then the second piece we've got here is our PUA rider. Now, all companies have different terms. In this example, we've got ALIR, which represents additional life insurance rider, but we're coming up with the same $100,000, but instead of $100,000 of it being the premium, only $45,000 is. So question number 1 was what? I want to maximize cash value, or goal number 1. Does this do that? No. It's better than the first example, but it does not maximize it, meaning the limits that this company offers, we can be a bit more aggressive and reduce the premium further. Number 2, do you remember what that was? I want to have flexibility. He's got more flexibility in this example than the first one, because what I'm committed to is the premium. The second piece, that PUA rider, is very flexible, but I'm still billed for $45,000. So if you're in the hook for $45,000, do you feel like that's flexible? More flexible than $100K, but not that great. And then number 3, I'd like access to the cash value for opportunities. Does he have access to the cash value? More than the last example, but is it attractive? It's by year 10, he's paid in a total of $1 million, $100K per year, and he's got $1 million. So that's his break-even point. Attractive? Not really. If we're comparing it to the last example, yes. And this is the exact same company, exact same product, like everything's the same with this, other than the design. But is that attractive? Not really. Let's put another red X by that. And then let's do this optimal. Optimize the cash value. So we're going to call this one optimal, and that kind of gives it away as far as what option you would take, but that's okay. I think you see where I'm going with this. So same company and same product, again, just the one policy. But what do you notice here? 100K per year, your cash value. Look at that. Just about 84% right out of the gates in the first year. When'd you break even? Just about year 6, where you have paid in 100,000 times 6 years is $600,000, and you're just about at $600,000. This, by the way, can easily be improved. This is not a product we use a whole lot. This is just a traditional product that's the most commonly type of whole life insurance policy that's sold in the industry. So this is a great example to use when we're looking at these 3 options. All premium, the bad one, middle of the road, 50-50, and then we've got an optimal policy, which what it involves, when I say optimal, we are reducing the insurance premium as low as we can here, very close to the minimum, $10,000 or 10% of the total payment. Does this maximize cash value? Yes, especially when looking at the guarantees. Does this provide flexibility? That was number 2. Yes. So the $100,000, my minimum premium is $10,000. The true minimum may come out to $11,000 or $12,000 per year, because I do have to cover the cost of the term insurance rider. We've got other videos that cover that. But my point is, I can pay up to $100K per year, but set it up in a manner where I'm only billed for $12,000. And then, goal number 3, I'd like to be able to access the cash value for opportunities. Can I do that? Yes. We've optimized it in this particular example. So optimizing the cash value gives me access to more capital for opportunities as they pop up. That is typically what people are interested in. And by the way, this is just one company and it's a sample. When you start to look at different companies and products, they all have different rules with respect to the actual flexibility. Some companies will allow you to commit to the minimum premium only, call it 10K or 12K when we add all the riders and everything, but then you can just add additional funds anytime you want. Whereas some carriers, some insurance companies will say, hey, you can set it up like this with that minimum $10,000 premium, but we still want everything to be paid at once. So you've got to pay the full $100,000 every year, and then if you need to adjust it, you can, but it can only be done on your policy anniversary date, which is a fancy word for your premium due date. So in this example, this is with MassMutual. They're a company that's very accommodating to individuals that are comfortable with a one-time per year payment. Other companies, like a Guardian, for example, and there's many others or a few others, will allow you to commit to the minimum only and pour in excess funds anytime you want. So companies and products are important to be aware of. This way I can use the policy how I want to accommodate my goals. Here's the 3 options side by side. So as you look at this, what questions come to mind? especially if you've been presented whole life insurance in the past and it looked something more like options A or B, not option C. Usually, what comes to mind is what we've got up here in red. I wasn't aware of that, or I didn't know you could do that. Why wasn't I shown this before? On that question, why wasn't I shown this before? Talked about what? I have to know how. The agent needs to know how and also needs to be willing to set up a policy correctly. When I say know how, it does take time to learn this. One, learning the insurance company or companies you're working with, the actual software, the rules as far as what are the limits with the premium and PUA riders, the MEC limit, which is a taxable limit. There's a lot that goes into it. And then, in my opinion, it's valuable to gain experience or work with someone who has a lot of experience to know what goes on that's not seen on the illustration. That's very important, meaning what actually happens and isn't just shown on an illustration, which should happen. I want the real stuff. So that's important too, and that goes into knowing how to set up things correctly, but then being willing. So here are the compensation amounts that we, our company, would receive if we sold any of these designs. What do you notice here? Which one do you think I'd rather sell? I shouldn't phrase it that way. Which one gives me more money? Or if you're an agent, which one gives you more money? Option A. You make more in option A in the first year than you do over 10 years with options B or C. Like right there. And the reason why is because the higher the premium is, the higher the commission is. Especially with a traditional whole life insurance product, because the premium does not generate any cash value in the first year, often the first and second year, which is why the company can pay a higher commission on that. Option B, what we did was reduce the premium. We put more into PUAs. By reducing the premium, that reduced the agent commission, particularly upfront. There are renewals with life insurance policies, which is why we see that small amount every year thereafter. The total commission is just tallying up what we've made over 10 years. And then option C, there you go. So when I say must be willing, that's what I mean specifically when you look at how compensation works. And this is all that exact same product with the exact same company. It's all the same. We're just pulling levers in order to maximize the cash value. And then naturally what happens is it reduces the premium and compensation. Now, from an agent or agency perspective, if you're watching this and saying, hey, I still need to be able to run a business and generate revenue so I can maintain a profit, I get that, and I've learned about that, and I am always learning about that. Here's what I can say. If you're setting up policies for maximum cash value, because that's what your clients want, what happens here is, yes, you do reduce your commission, but there is a residual factor, and the business stays on the books. Speaking personally, from what I've seen in agencies I used to work at years ago, compared to setting up policies with our clients for maximum cash value, the persistency rate, meaning policies that do not lapse, individuals keep them and continue to make payments, persistency rate is much, much higher. So what happens is, yes, you make less per each sale, but it stays on the books, so you don't have to worry about a lapse and then no more renewal commissions. You get a lot of this referral business, which really helps your practice grow. And you can sleep at night not knowing that there's someone else that can look at your design and say, hey, I can probably design a better one than what you were shown. And now you got to go up against competition and resell what you had sold before. Like it's not worth it. And which one would you want if cash value is your goal? Like just ask yourself that question and then the money will come naturally if you do the right thing. But anyway, I hope this was helpful. What we're going to look at in our next video are different products and what the growth rate looks like just by having awareness on the different products that are available. So I do hope that you enjoyed this video. If you did, please let us know. Leave a comment below, hit the like button, subscribe for more, and as always, I hope this helps. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you If you have any questions, please leave them in the comments below. And as always, I hope this helps.